Broadcasting from the commodity capital of the world, Zurich, Switzerland, this is Insider's Guide to Energy.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me is co-host Johan Oberg. Johan, what's going on today?
Well, afternoon or morning, Chris. For a time now, we're being on different side of the pond. And I missed you a bit. I've been away for a few weeks, so I'm ready to come back to it. And I haven't seen you since you left. So I will return the question. How are things?
Things are amazing. Insider's Guide is coming now from Washington, D.C. Very exciting. We're very happy to do that. What we're looking to do right now is have an episode on finance and what's happening in the market and how we're doing on that. So we have an equity group with us. I suggest we just kick off on the show and get our audience right into this. What do you think?
Let's go. It's an interesting topic, and I think we touched on this a few times, so I'm ready to go.
All right. Well, with us today is Cody Meyer. Cody, welcome to the program.
Thanks, Chris. I appreciate you having me on today.
So, Cody, I always say this, or Johan says this, we know who you are. We've done a bit of homework. Our audience at this point only trusts us to bring you on board. Maybe it makes sense for you to share a little bit about your background and who you are and who you work with.
Certainly. Hi, everyone. It's a pleasure to meet everyone today. My name is Cody Myers. I'm a managing partner and co-founder at Green Rock Energy Partners. We are a sustainable infrastructure-focused private equity fund. By way of background, we focus on growth equity. So we make equity investments largely into renewable energy projects. And so we focus on lower middle market spaces. So traditionally that would be $5 to $25 million equity investments in companies that are growing and looking for a capital provider to help scale the business.
Well, cool. So you came on Insider's Guide to Energy. You obviously work in the space or looking there. What kind of things are you seeing, or what are we going to talk about today? What's keeping you up at night these days?
I would say the thing that's keeping me up at night is really where are we at in the energy transition and what's going on. I think there's a great narrative with what's happened over the past 24 to 36 months. Where we're primarily focused on right now is the hard to decarbonize industries. I'd say, difficult is an understatement in where these are at. This would largely include aviation, rail, heavy duty transportation, building materials, chemicals, and across the board from there. I think what's interesting these days is that the narrative out there for the energy transition is largely focused around electrification, primarily for passenger vehicles. And I think when you look at the energy complex, there is a massive story that isn't being told right now, which is really kind of retooling a whole sector of the economy.
And there's quite a lot to dig into this one, especially on the electrification part, which I think is really, really interesting. But for my knowledge, and as we said on the pre-call, I'm famous for asking some of the less qualified questions. But I'm really interested, though, in terms of looking at this financial trend in terms of investment. So we've seen now that in the last couple, you mentioned 36 months plus maybe 5 years, whatever that time span is. But from your perspective, do you see a kind of a breaking point when investments actually started going into building sustainable business? Because I think that we talked about it quite a bit, but if I go back, I worked in sustainable solutions for quite some time, but the investments was never there. So is there a breaking point now is when you see that actually took off?
I think that is the billion or trillion dollar question, Johan, and that's what everyone's kind of waiting
Even
for.
backwards.
I use history to kind of help me figure out where the future goes. I do believe there is some sort of, you can learn from the past. And when I focus and I look at things, I look at, history from a broader base, is that if we go back to, say, 1850, we've been through 3 energy transitions before. That might be a controversial statement, but, hear me out on this one. When you look at kind of going through different transitions, we've gone from wood to coal, and I would say that lasted about 65 years. The emergence of coal, and I would say that went from maybe 1850 to 1915. And then we've gone from really coal to oil, and that was really 1915 to maybe the 1970s. Where it's kind of interesting right now is that we're living in the age of oil and gas. And what we're seeing right now is that we've actually been in this energy transition, and Johan, I think this touches on your kind of career and background, is we've been in this for about 10 to 15 years at this point, maybe even upwards of 20 years. And this is really the shift to renewables. We're really rebranding it as sustainable, which is renewable plus low carbon. You look at a lot of renewable solutions out there, they aren't necessarily low carbon. We're really getting into what's called carbonomics, which is the focus of the levelized cost of carbon abatement. But back to your question, Johan, is that we've really been in this phase for about 10 years. And when you look at kind of the transition, let's say from coal to oil, I think there's a fascinating story to talk about, which is Winston Churchill and kind of his conversion of the British military to oil from wood or from coal to oil, and really kind of pushing their whole fleet. And what that did was that really built storage tanks all around the world, and thus kind of created the catalyst for it to change the globe from going from a coal-based energy to a oil-based energy. And I think what you're highlighting right now is what is that catalyst moment? And to be honest, we're searching for that right now to figure out. A lot of these investments have been made. You're looking at institutional capital raising money, but you're really wondering, when is this going to take off, and when is this really going to scale?
Which is kind of gave me the answer to what it was, but I really like the history part of it as well. We're talking about investments, and you're talking about usually investments is short term. And we're talking now something that is a transformation, and some people talk 2050, someone talk 20 to 35. As an investor in new renewables, in new technologies around this, how do you look at this ratio between investment and also kind of the time axle that sits on this? Because some of these projects are long.
I think everyone's realizing that it is challenging, no matter what you're doing, whether it's EV charging stations or whether you're converting, high heat industrial processes. It takes a while. I think one of the biggest challenges these days we're facing is really getting scale. I think the rate of adaptation, the rate of conversion, we've all lived through a software era where, I'm sure you're familiar with this. Right away, software comes out, everyone switches over, that's all great. It's another thing when you need to retool your physical infrastructure, it just takes time. So, going back to kind of the point that you're making is, yeah, I mean, this has got 30 plus more years left, and 30 to 40 more years. I know people don't like to hear that. And it's always, what is the magical number of is it 2050? Is it 2060? Coincidence that they all end in 0 or 5? I think that's really where everyone goes, but it's a good question.
So you mentioned, though, that some industries were better than others. You talked about rail and some other industries maybe being a little bit harder in the decarbonization or going through the transition. How is that an opportunity from an investment point of view that you're looking at? And is that somewhere we can make a bigger impact than maybe just EVs, which are not probably the largest part of contributing carbon?
Well, I think this is touching on kind of both your questions together, is that people have focused largely on light duty transportation because that is low hanging fruit. I mean, I applaud Tesla for what they've done, let alone GM and all the other auto manufacturers and the conversions there. Those are low hanging fruit that you can convert, and the time frame for those are much shorter. When you look at things like, let's take commercial industrial processes, let's say high heat processes, critical part of the economy, they use a lot of energy. You'd be surprised. I mean, when you look at kind of the division of energy and you take electricity as a portion, let's take residential, commercial, industrial. I mean, commercial industrial could be, depending on which country you're in, north of 30%, and depends on whether you're a more manufacturing country or not. But largely, it's a third of kind of your overall energy consumption. And this gets back to kind of, let's say, high heat processes. Electrification is very challenging for that. It's just to kind of get to those high temperatures that you need on a BTU basis. It's a Fahrenheit basis with BTUs. It's a very challenging part. And that's really where we're kind of heading to, is that you're going to have to find all different ways and uses. For example, we focus a lot on renewable natural gas. That is an area where you can use biogas that's been around, that's produced electricity. And Europe's been doing this for, 50 plus years. And rather than producing electricity out of it, which we now have wind and solar that does a great job, you can use that biogas, clean it up, inject it in the pipeline, and that can be sort of a substitution fuel, or what we call a drop-in fuel, so you don't need to build new pipelines for it.
And then recently I was speaking to some folks over in the more industrial part of Germany, and they were focused on hydrogen as well. So steel is very prominent in that region. And so they did talk about biogas. That was one of the proposed things that they do, and there's a European pipeline initiative taking place for hydrogen. How does that play into what you're talking about?
This is where it's like, back to Chris's question, or sorry, Johan's question, my apologies, of how long is this going to take? And you look at hydrogen right now, I think it's fascinating is that the concept of hydrogen, it is a great molecule. It is a great opportunity to kind of, really go to a net zero emissions product. The challenge is how do we produce it? And how do we produce it at scale? And how do we make it readily available to everyone? And that's really where the difficult part, happens. It's one thing when you build wind or solar, you've already got transmission wires, transmission distribution already kind of going out to people. When you look at hydrogen, it becomes a lot more complicated. We'll take a step back and say 2 ways to produce hydrogen, from how we study it is really electrolysis. So I take water, I take, H2O, I take out the O2, I take, I've got my H2 there. Electrolysis is one way. The other way is steam methane reforming, which is taking your CH4, heat and pressure. Refineries do this already and produce hydrogen that way. The problem is right now is that largely a fair amount of the hydrogen at the refineries are being used to produce renewable diesel or sustainable aviation fuel. And I'd say from the electrolysis standpoint, you need electricity to produce your hydrogen. And the problem is that large amount of the renewable electricity is already being used for things like passenger vehicles and decarbonizing the electricity grid. So there isn't necessarily just a bunch of renewable electricity hanging around there just waiting for uses. And so the challenge that we're finding right now is the production of hydrogen sounds great in concept. It's just we're too early right now. And it's taking a lot longer than everyone expected. And then the second part to this is really the distribution of it. Storage. When you think about hydrogen stations, you're going to need to do hydrogen storage around, take Germany, for example. They've got great petrol stations, but those are geared for liquid fuel, gas oil and things like that. They are not geared towards hydrogen storage. And so we'll need to at least, over time start converting those to offer both those options. And when you get back to the steel manufacturing industry, they need a lot of energy. There's no doubt about that. And so I do believe that there are opportunities for hydrogen in those industries. They're low-hanging fruit on a relative basis compared to converting, let's say, heavy-duty transportation, converting one steel customer compared to, call it, 5,000 trucks. It's much easier to go with that commercial industrial customer, but it's challenging to say the least. I mean, we are constantly studying this, and I would say there is no perfect answer out there.
So what are your thoughts around that then? We had on the show a few times discussing this in terms of transportation. Okay, light vehicles, I think the battle is over somehow, even though people might argue differently, and it's towards electric. Who am I to know? But I think that's where the trends is, at least we're seeing today. Heavy duty is a different one, though, in terms of hydrogen versus electric, et cetera, et cetera. Where do you... I can understand the industrial one because that's a different deployment, but how do you see... What are your views on heavy transportation?
This is always disappointing for everyone to hear, but it's going to take longer than we all expected. Is that, when we're looking at passenger vehicles, a hydrogen solution, heavy duty transportation, long haul transportation sounds great, but you need that network built out. And that's where we're really heading back to, it's going to be a bridge fuel to get there. Again, how long is this energy transition going to take? Not 5, 10, 15 years. It's likely going to take 30 or 40 years. And maybe the first 10 to 15, if not 20 years, is a blend between, for your long haul trucking that you don't necessarily have fleets that come home every night, it might look more like a renewable diesel type of solution. And, that's not zero carbon on it. We talk about carbon intensities here on a grams per megajoule basis, depending on what your feedstock is, whether it's, fats, oils, or greases. Let's say tallow based, for example, your carbon intensity might be closer to 20 or 30 grams per megajoule. So you might be going from 100 down to 20, not necessarily to 0. So it's a step in the right direction. But when you think about hydrogen, as far as kind of getting the whole country to turn over, on a long haul transportation, you might start out with renewable diesel, and more on a short haul transportation, even if it is heavy duty, say Class 8 trucks, 80,000 pounds around there, give or take, depending on your country's weight limit. We also see compressed natural gas and liquefied natural gas as solutions there. So for the next 15 to 20 years, you might go with a renewable diesel or a CNG/LNG solution. And over the long run, you might head more towards a hydrogen solution that rather than being CNG and LNG, you might take that renewable natural gas and use a steam methane reforming to convert that to hydrogen and convert it that way over time.
All right. So what I'm hearing is a pragmatic approach to solving the problem from you. And I also know from the introduction, you're an equity guy, and equity returns, you're probably not looking to get paid in 2050 or sometime out. You probably want to find a little bit quicker return on your investment. So I've heard you talk about drop-in fuels that work today. So synthetic diesel or jet fuel or some other fuel or gases. Is that the kind of bets you think need to be being made today to meet the gap you described in the show opener?
Absolutely. It's a balance between the two. Say for example, if we're looking to build a CNG station, we look at that as an immediate return today. We can use renewable natural gas, get an immediate return today. What we're thinking about with that is when do we add on, CNG plus hydrogen, and when does this move towards a hydrogen station? And so you have to think about this as more of a longer run. And then we're also, we're in private equity where we're making investments in companies. And when we're thinking about this, we're not thinking about the investment for ourselves and what our return are. We're thinking about it for the next investor. We're building, and then we have a finite life period where we might hold this for 10 years or so. But when we're thinking about infrastructure, this has a 30-year, 40-year, 50-year lifespan. And so when we're making these investments, we're really making these in the premise of when the next person buys this, what does it look like for them and what does their business look like? And so for our time span, when we kind of, let's say, take a CNG station, we might not necessarily, get to hydrogen until maybe year 7, 8, or 9. But for the next buyer who steps into this, they're going to have the ability to kind of, ride this out over the next 20 years rather than CNG goes away and you've just got a plot of land there and obsolete equipment.
Now, one question that comes to mind, and I said I don't ask harder questions, but this is one that came up in a recent conversation, is I've had a number of guests tell me that equity for a lot of these disruptive technologies, because of the rate of return for equity groups coming in and the pro forma on capital, isn't necessarily the best if I'm going to do some innovation to the transition, the best funding to go look for some of these capital intensive long-term projects. Do you agree with that statement, or do you understand what I'm trying to get to or what I've been told?
We live this conversation every week, and it's a difference between technical risk and technology risk. Technical risk and technology risk. The businesses that we are in are highly technical, meaning that there are a lot of complex areas. Fortunately, with education systems, you're blessed. Myself, I was not included in this, but you're blessed with great engineers, whether they're chemical engineers, civil engineers, electrical engineers, mechanical engineers, and they understand the technical nuances of this. A lot of this technology is already existing. So for example, let's take steam methane reforming. If we want to build steam methane reformers, you go to the refinery industry because in refineries, you produce a lot of hydrogen. And when you kind of look at what's going on for the equity returns, if we were to take a technology example, for example, steam methane reforming and replicate that, I can underwrite those risks and say, hey, this technology exists there. It might not exist at this scale. It might not exist necessarily in this application, but I'm not necessarily taking on that, technical risk there. Or I'm taking on the technical risk. I'm not taking on the technology risk. Like I'm not worried whether it's going to work or not. It doesn't have that binary outcome. When you get to binary outcomes, let's say technology risk, that is where you're going to have to move towards a venture capital. So that's kind of the division between private equity and venture capital, where it is a binary risk, albeit in a technology risk. If it works, it's going to scale and you're going to have way greater outsized returns. So when we think from a return standpoint, we're thinking, we want to invest in something that needs a little elbow grease to kind of help scale the business. It's not really new technology, versus a venture capital firm will say, hey, I need to get behind this. This is a binary risk, but if it works out, I'm going to get a way outsized return. So going back to your question is that capital formation is getting complicated. You hear a lot of people who are, whatever, it's decarbonization, energy transition, you could brand it any different way, but it's tough for the entrepreneur to figure out who's the call and what do I make and what does my business look like? And so I fully appreciate that and say from a return standpoint, everyone needs returns. I did have a conversation with someone the other day and they were talking about the returns and they were saying, boy, this isn't cheap. And I was saying, well, for my investors, their opportunity cost is investing in, government bonds or even, other things like corporate securities. So like we have to be able to provide an attractive return, do good and do well at the same time.
So if you look at from an investment point of view, from a technology point of view, or from a kind of an energy transition shift, we've seen slightly differences between Europe and US. But if we look at the US, for example, in terms of electrification, both from we're talking about our cars, but also in terms of our houses and heating and all the rest. I guess that's the technology is there.
Yep.
You have your solar, you have your renewables, you have your heat pumps, or whatever that is that will solve this. How do you see something like this that is actually happening right now? And is this going to happen in the US in the same way as it is in Europe, or do you see any differences?
Oh, it's fascinating to watch the European versus U.S. kind of foot race on who is leading the charge here in the energy transition. I'd first come back to say 10 years ago, and over the past 10 years, us as Americans kept looking at Europe and like, if I were only doing business over there, if I were only doing business over there. We kept looking at how advanced Europe was. They were less focused. I know that they have, EUAs for their emissions trading schemes. But when we kind of look at Europe, Europe was more advanced. In the US, we had the renewable fuel standard for liquid fuels, but we really didn't have any sort of carbon programs. What we're looking right now with the Inflation Reduction Act of 2022 is the US just leapfrogged Europe. And we do believe the Europeans will get behind this, but they are facing the battle between energy security and energy transition. So I know that's a lot to unpack, but when you look at the US, I do believe we haven't seen the full impacts of the Inflation Reduction Act. A lot of the stuff doesn't kick in until next year or the following year, but it really is kind of a shot to the arm, and things are really starting to run here. So I think it's complicated though when you compare the U.S. to Europe. When you look at the markets overall, each state kind of acts as its own country. Versus Europe, you have the European Union, but things aren't necessarily jiving fluid through Europe. Different people are taking different directions. But I think the overarching interesting data point is that both areas are figuring this stuff out as they go along. When you look at ISCC regulations, which is the government regulations for Europe, and you're going over to the US and you're looking at the California Low Carbon Fuel Standard Program, or you're looking at the renewable greenhouse gas initiatives and what's going on, it's complicated. No one has this figured out, but there is an interesting arbitrage between the transatlantic opportunities.
So in the U.S. and just having moved back from Europe, renewable energy is very politicized. If you talk to the common person, they're either for or against it, and they associate it with politics. So the IRA, how political will that be in the future from an investor's point of view? Or is there enough lock-in that you're making good plays or good investments, expecting that to be in place for the next 10 years or some long period of time, as it says in that?
We underwrite the IRA as making good projects great on a return standpoint. It doesn't make a mediocre project good. So I'll first put that out there, that if a project, didn't have a good basis without the IRA, we're cautious to kind of step into it. So I'll put that one out there. But when you look at kind of the politicalization of, renewable energy, we've seen with the recent presidential debates, the Republican debates in the U.S., there is a lot of different views on this. But our belief is that when you look at red states versus blue states, the IRA will largely benefit the red states more than the blue states. It is just how, the geography of the country is set up and how dollars pouring into these states benefit. So I guess coming back is that I think right now it is more fresh in everyone's mind on which administration was in there passing it. But I think as we go along over the next couple of years, I think people will be more focused on the dollars. And I could say is that, the biggest winners of all of this, I think, this is an undertold story, is really union labor in the U.S. I sat with a couple of union leaders the other day, and I had this conversation to talk to them about the IRA. And I said, listen, we have two requirements in order for us to really kind of upsize our investment tax credit or producer's tax credit. And that requires I use labor that is prevailing wages and has apprenticeship programs. Didn't explicitly read union labor, but when you look at the country overall, it is going to be union labor. And so you have this interesting paradigm where it's like overall the red states are going to benefit from it, but you're also going to have union labor benefit from it. So when you look at these kind of two sides of what's going on, I think we have yet to see this fully play out, because when I sat down with the union leaders and I started talking to them about, how this is going to be and what's going on, they were fascinated. They weren't aware of any of this. They just basically said, as we kind of wrote this off, figuring someone else was going to get the advantage out of this. But I think, it's 2,000 pages and no one really wants to spend the time to read it.
And then the other thing that's kind of happening, kind of the perfect storm of this, is interest rates and cost of capital. How is that impacting where you're sitting on the equity side in the near term?
People aren't going to want to hear this, but as the interest rates go up, our returns go up. It's all traded on a relative basis. So this is kind of back to the point that Johan had asked about, which is when I look at rates, let's say that risk-free rate is at 6%, and let's say that's just Fed Treasury rates. Corporate rates might be closer to 8%, 9%. So that means that as I need to make my rates, private debt will be closer to maybe 14 or 15%. And that means my rates need to be high teens, low 20s. And so as rates have gone up 4 or 5%, it's basically shifted up all the returns, maybe not point for point on that, but it has shifted up overall where we need higher returns. As if that's bad and that makes projects complicated, what you get from the other side of this is that when we do debt financing, you're also going to need higher interest rates on your debt financing. So it hits you on both sides of this. So I would say, with the higher interest rates, we are seeing more challenges for projects. But again, if your project is missing out because rates have gone up 2%, like our whole perspective is that a good project is a good project, whether rates are at 2% or 5%, or whether the IRA is there or not.
So to summarize that, would you say then that currently, do you see an impact in the last, let's say, 24 months or 12 months? Finance here is shorter times, 6 to 12 months, in terms of investment overall. Do you see any kind of tendencies of that going down with the interest rates, or is the IRA covering this short term?
I think everyone is facing inflation right now in addition. So building materials around there, things like stainless steel have gone up, threefold. And so everyone's facing those challenges. So it's a multitude of factors. But again, with the IRA, rates going up, you are seeing people who have marginal projects stepping away from them. From our perspective is that, if we're going to get into a project, we need to know it is going to well clear our return. But I'd say overall, there is more capital out there than projects. But the challenge that you're going to find is that the level of projects that the requirement for the projects have now increased, so that capital might not match it nearly as well.
So another question we had many moons ago, I was about to say, but quite a few episodes ago, we talked about to another investment, larger investor, and we talked about legacy investment in energy and new investment. So we start looking at, okay, but what is new capital going into new projects for renewables and for energy, electric cars, etc. But he says that one of the ticking bombs is obviously where the equity is sitting today, which is in oil and gas, and a lot of that money is not shifting; it's just devaluating in terms of long term. The risk for long term loss is imminent. So he said, how do you see that? Is the capital going into new investments new capital, or is that shift starting now to move from existing oil and gas investments?
I think this is where it's another controversial statement. From our perspective, we don't do traditional energy. Our backgrounds, my business partners and I's backgrounds are around traditional energy. Our focus is sustainable infrastructure. So I'll put that out there. With that being said, we are seeing, let's say institutional capital, whether that's endowments, foundations, pension funds, sovereign wealth funds, investors like that shift towards the renewable energy side, the sustainable infrastructure side. Albeit, I think that there is this sort of challenge between energy security and energy transition. And the controversial statement comes is we are an all of the above type of belief, which means that we believe natural gas, crude oil, so fossil fuels, there will be a lot of different energy solutions to this that will be around for the next 20 or 30 years. And we're actually seeing something different, Johan, which is a flight of capital from the traditional energy space to the renewable space, and is really leaving a gap in the traditional energy space. I think what we're going to see is more consolidation on the public equity side and the traditional fossil fuel players. But the one thing here is that we still do need fossil fuels today. I mean, let's take, for example, plastics, like very hard to solve. Like, I think people are trying out that pyrolysis, renewable plastics is sort of a goal, but that is a challenge. And what, touching on kind of where you're at is that, I think people believe that there is this massive flight where everyone's moving to renewable energy and hey, everything's good, but this stuff doesn't happen overnight, like I said. And I think that, there will be an undercapitalization in the traditional fossil fuel space over the next decade or two.
But I've also seen or believe I've heard, and I can't give you a statistic or a person that I can contribute it to, but there's a huge demand to place capital in renewable, right? So there's a lot of capital going there. There's a lot of funds that have said
Absolutely
ESG is the way to go. We only want to be involved in these things. And then we also are told there's probably $1 trillion gap between, the transition goal from that and the capital. So is there really capital sitting and is waiting to be placed? And are they having a hard time? Is the rules are kind of changing today, or is all the capital that's sitting there, the pension funds and folks like that, finding good projects to place their capital in these days?
The problem is that it is what they're looking for. So they would like a company that has, $100 to $200 million of EBITDA, that's been around for 10 years, that has a seasoned management team who has been in this business. And you go back to the hydrogen industry and it is just emerging today. And what they want versus what is out there is where the dislocation happens. And so when you think about kind of going back to history again, when we go look at like Standard Oil, for example, that was a roll-up play, and then they kind of broke it apart. But what our belief is that right now we're kind of going through this energy transition phase where there's a lot of smaller companies out there. Everyone's getting them off the ground. We're going to hit a consolidation play coming up that basically, buys up the companies, makes it larger, and then that larger capital can kind of step in there and start to put more of the money to work. But the challenge that we find today is that this business is built through smaller projects. I mean, there are billion-dollar projects out there in which larger institutional capital is chasing, but those larger projects don't have, a 10-year track record with a seasoned management team that has, all the boxes they want to check. And so, again, there's just a dislocation that's happening right now. But I would say, yes, there is capital out there. And the challenge is that just fitting that capital for what they need is the challenge.
So where do we fill it then? If you look at we talked a little bit about what happened in the future and then the past. We looked at the equity, where the money is going now. But if you start looking, we touched a little bit on transportation. We touched a little bit on electrification and a few other things in terms of mixing the kind of the energy bag, so to speak. But where do you see in the next coming years, from an investment point of view, are there specific areas to stick out where you see that this is where we're heading?
I see it as consolidation. I believe that a lot of these players will be stepping in there, looking at these as more platform investments and acquiring other projects or other companies and rolling them together. One of the more complicated areas that I think this is worthwhile to talk about with viewers is human capital. The biggest shortage out there, one of the biggest shortages out there, you talk about raw materials, but you could also, the bigger story is human capital. Whether you're 0 to 5 years out of school or longer than that, we are transitioning people. We are transitioning the workforce. People, again, there isn't necessarily that 30-year, seasoned energy transition executive. Just doesn't exist. And we are transitioning people who come from different backgrounds. But what you're going to see is this interesting mix, which is a consolidation play where people are buying it not only to get scale, but to bring on other individuals who can help get projects done. Is that we went through a phase over the past maybe 12 months, 24 months, where everyone was really promoting more pipeline growth abilities. I mean, I get that. I look at, we're in the renewable natural gas space. I know that the utility demand is 4 times the size of what, the current production is in the US. For renewable natural gas, the utilities are mandated to buy, in North America, they're mandated to buy 4 times what the current production is. Like, I get that. That's a very easy story. The problem is that a lot of these projects are smaller, and also they don't necessarily have the teams behind them. So the name of the game is to kind of find smaller projects, help grow them to be small to medium scale, build out a good team from there, start to go acquire more. so that as that larger capital is out there and available to kind of step into the stuff, they could then step in with a lower cost of capital. And then that's kind of how we prime the pump. But part of that is, again, the consolidation strategy.
But wouldn't you say that if we look at consolidation as a strategy moving forward, which I can buy into for sure, and we saw that in all shifts in terms of technology as well. But on the same side, you're saying that we don't have the experiences on large projects, etc. So when the consolidation happens, do we have experience then to manage the consolidation? Because that's not straightforward either, even in traditional industries.
I believe we have the human capital experience out there that isn't necessarily in the right part of the workforce. So what does that mean? Well, I think we've got a bunch of great chemical engineers who know a lot of great knowledge, but they need to be repositioned from maybe a previous industry to a new industry. I believe we have a lot of great business development individuals who are great at sales, but their focus is maybe something different. Maybe it's more software based, where they need to be more into procurement for the feedstocks for these specific projects. There's a lot of gaps in kind of skill set where it's not that the skills don't exist out there, it's that those skills haven't made their way to where they need to be to help the industry grow.
Where do we go from here? We're getting towards the end of our time for this interview. We've got a bunch of problem statements on the table. Take out your crystal ball and be bold.
I think there is a great opportunity over the next 5 to 10 years. I think it's going to take a lot of elbow work. People are going to be building stuff up from ground up. I think there is, I'm an eternal optimist. I think that overarching, there is, the environment is really, the policies are put in place for this industry to excel. It is a matter of kind of lining things up and being patient. And where the crystal ball kind of leads to is that everyone wants me to tell them that in the next 5 years, this industry is going to be booming, the catalyst is going to hit, everything's great. My challenge statement is that good businesses are good businesses. And if you stick to it and you do a good job and you work hard, that the returns will be there. So, the crystal ball comes back to is that we are going to be in this paradigm for a lot longer. It won't look necessarily how everyone imagined it to be. And where we're going to go is, it's just be patient, and those who do well are going to succeed.
Which sounds great. I love the half full analogy as well. The crystal ball being positive. I think that's one of the reasons we're onto this show as well, to hear
absolutely
what comes towards the future and how this actually is a positive transformation and not just a fear factor around it. I always think there's a little bit of a mismatch between the investment and patience. I always like when people say investment and patience in the same sentence, because for me that kind of goes against each other sometimes, because you want short term. But I think this was really, really interesting. I thought the whole idea of looking at the consolidation of the different sources, to look at it from an energy mix, at least short to mid-term, before that transition is over, I thought it was really interesting. And also start looking at the capital that comes in and how you allocate that. I thought this was really interesting. And I think the historical 3 shifts is something I for sure will take with me as well, because I thought that was an enlightenment thought I never thought about, or I haven't for a while at least. But with that, thanks, Cody, for coming on. Great to have you on the show. It's been a pleasure. And I'll hand over to Chris.
Yeah, Cody, it's been a great conversation. Thanks again for coming on our podcast today.
Thanks, guys. I really appreciate it.
For our audience, we hope you've enjoyed this content as much as Johan and I did while we made this show. If you do, please share it with your friends. Follow us on Facebook, follow us on YouTube, and don't forget to tune in again next week for another episode of Insider's Guide to Energy podcast. Bye-bye.